welcome to the Monday Futures Market Outlook for February 25th, 2013. This is Patrick Ceresna. For those of you that have not had the opportunity to try out our amunersource.com trading room, complimentary memberships are available on our website. All of the analysis that we do during a Monday Market Outlook video is available in written form in our Market Timing Strategist newsletter. Please visit the website if you want to learn more. As always, we start with a chart of the U.S. dollar index futures, and the dollar index had a very good run in the month of February, having progressed all the way off the 79 lows, all the way up to our 81.75 key focal point up above. Really, at this stage, this is an area of material overhead resistance, and it is quite natural for the U.S. dollar have a little bit of a correction off this level. We think that there is room for even a drop of another full point down towards 80.50 on the downside during a corrective phase. But I think that at this point we're going to want to treat the U.S. dollar relatively more range bound, with this now being the overhead resistance and the support at 79 being the lows. At some stage this year, we may see a U.S. dollar that even strengthens all the way back up to the 84.50 level, but we don't necessarily believe that that's going to be a straight line move from here. Next here, I want to take a look at the Euro futures, and the Euro has come to a key support at this 130-150 area and has bounced off there. As we get the results of the Italian elections, we'll see some of that selling pressure that was caused by uncertainty around the elections probably unwind. We could see a Euro retrace properly back to even 134, 135 on the upside in the next little bit. Even if there's enough catalyst, there could even be a double top retest, but we wouldn't be putting a lot of probability weight on that at this juncture. At one way or another, as the euro will strengthen, if it does ultimately fail to make a higher high throughout that cycle, that would only solidify the major top for the euro for the year if it did fail to do so. So some very important price action will be developing and going into the month of March, as we'll see what's in store for the euro. Next year, I want to take a look at the 30-year Treasury bond, and we're approaching and have been consolidating at a very key level. Really, at this juncture, we are speculating that this could be a short-term bottom on the Treasury bonds, but we have yet to have price action confirmation. We've been looking for a break above this 143, 144 level, where the highs of the consolidation of the month of February have been, and once we really gain some price action confirmation, then we can be more confident in making a call like that. At this stage, we are seeing definitely buyers coming in here and supports holding, but that's not enough to make a rally in itself, so we're going to want to see that follow through. If by chance we break below the 143 level, we're going to have to revisit the whole thesis of the bottom being here, and then we'll see how it would trade out from there. Next year, I want to take a look at copper futures, and copper had a substantial sell-off off the highs. We were looking for the highs to be put in somewhere there. We were suggested it could even have a short-term pop all the way up to 387 before the selling started. But one way or another, we came from the top of the range, now going to the bottom of the range. A very oversold market on the very short term, so bounce back to the 360, 365 level on even maybe 370 if it's really robust over the next week is likely, but anticipate further consolidation in copper as there's no reason for copper to be going through any substantial expansion at this point. Next year, we'll take a look at crude oil. Crude oil actually did, on an intraday basis, trade all the way down to our 92 downside target, which is sort of a Fibonacci retracement zone on the downside. We still believe after a short-term strength back to 95, 96 that oil will likely weaken back to that 99, 92 level again, but that will probably act as a short-term support. Next year, I want to take a look at gold, and gold had that substantial drop when it broke that 1650 support line that we felt was so very important. We've seen it trade all the way down towards the 1550 focal point. Doesn't show it, but on an intraday basis, we did trade down into that zone. And really, at this stage, this is a level where we do anticipate there to be support, but very rarely is that support just a V bottom. So look for that 1550 to even be tested a couple times, and to find out whether that support holds at this stage. That makes this a very interesting level from a risk-reward perspective, but it may be premature to be rushing to accumulate. Next year, I want to take a look at the S&P 500, and what we really have here is a market that has a really good progress higher and had that correction last week. A lot of people got nervous about last week, but we were suggesting that very rarely does a meaningful market correction begin off of just a top like that. There's usually a topping formation, and suggested that that sell-off will mark only the beginning of that topping formation that will probably last into the first few weeks of March. At this juncture, with this rally starting this morning, we are likely to see one of two scenarios. The first one being that we just simply double top retest the high point at 1530, sell off again and create a consolidation, no different than we saw in September and October of last year. At the same time, there is always the chance that if given a proper catalyst, particularly if the euro has some strength based on the short-term results of Italian elections, we could always even see an S&P 500 that first pops even up to as high as 1550 and test those decade highs that are all developed along those highs, and then retreat back off of that level. That would put probably the first signs of a head and shoulders formation developing along there. Overall, we remain very adamant that the risk-reward proposition of owning the market is very poor, and certainly while there is for short-term traders room for the markets to have upward thrusts that are tradable, we in general do not think it's a good idea to be invested at this stage in the cycle, and that the next real good buy cycle will come in after a meaningful market correction. Just to review our key intermarket observations, we've now moved to more of a average stance on the U.S. dollar versus a good risk-reward proposition, as the dollar has now approached overhead resistance and rejected there. Similarly with commodities, we are right now looking at them in an average way, as much of the correction has already occurred, and now that even though there's room for them to weaken still to the downside, there isn't as much risk on the downside in order for it to be a poor proposition. And so we don't want to be rushing to accumulate commodities, but it's no longer a bad proposition. For bonds, we think it's a good proposition. It's a bit of a contrary play, as bonds have been correcting throughout this cycle, but we think that as there'll be a sector asset class rotation, moving from stocks to bonds as stocks begin a topping formation over the next many weeks. And so we think that there's room for bonds to rally. In regards to almost all stocks, whether U.S. stocks or global stocks, including most of the European and Asian indices, are quite overbought. And while they certainly, again, over the next few weeks can still have a couple stabs on the upside, the risk of owning them is pretty poor. That was your Monday Futures Market Outlook. Thank you for joining me.